You're listening to an AI audio recording generated to make our content easier to consume whenever and wherever works best for you. Now, let's dive in to discuss TechCXO's blog article, How Proper Exit Planning Prepares Your Company for M&A Diligence, coordinating the C-suite, managing the relentless pace of diligence, and securing the final signature on your terms. Selling a company is remarkably similar to selling a high-end property. If the asset sits on the market for too long, or is pulled and unexpectedly relisted months later, sophisticated buyers immediately assume something is fundamentally wrong. The exact same dynamic applies to the corporate mergers and acquisitions, M&A landscape. Engaging potential buyers while your internal house is out of order affects not only the current deal on the table, but also permanently taints future opportunities. Recognizing that you typically only get one chance to run a smooth, highly lucrative M&A process is the absolute foundation of success. However, executing a flawless M&A process is about much more than just the mechanics of the sale itself. The eventual transition of the business and the associated exit of leadership is an equally critical component of the deal. Approaching an acquisition without a clear, comprehensive strategy for the ultimate outcome is a recipe for stalled negotiations and eroded valuations. This is where rigorous exit planning comes into play. It is the vital preparatory groundwork, the deliberate alignment of financials, operations, and leadership expectations that ensures the overarching M&A process runs smoothly from the initial buyer meetings to the final signature. The pressure surrounding this one-shot opportunity increases exponentially when institutional investors are already involved. Venture capital and private equity firms inherently operate on strictly set timelines. Once these financial partners decide it is officially time to pursue a transaction, the entire process moves at a blistering pace. Successfully navigating this complex transition requires meticulous preparation long before a buyer is ever engaged, and no one is more central to this high-stakes work than the Chief Financial Officer. Exactly how the CFO prepares the organization depends entirely on identifying who is most likely to be buying the business. Most corporate acquisitions fall neatly into one of two distinct categories: financial buyers or strategic buyers. Financial buyers, such as private equity firms, are purchasing the company primarily for a future financial return. Strategic buyers, on the other hand, are acquiring the company to directly support, expand, or accelerate their existing business operations. The main difference between these two avenues is what actually happens to the company and its people after the deal officially closes. A financial buyer typically expects the current leadership team to remain firmly in place and the business to continue operating as an independent entity while executing a strictly defined growth plan. They evaluate leadership strength, the overarching growth strategy, and the potential for new market opportunities. A strategic buyer may only need your established customer base, a highly specific product, or certain proprietary capabilities. They often plan to fold those specific assets directly into their larger organization without retaining some or even many of the legacy employees. Because of the synergistic value they can immediately unlock, it is not uncommon for a strategic buyer to pay a significantly higher premium for a company. Unless the board of directors has a definitive, clear-cut preference, optimal exit planning dictates preparing for both types of buyers simultaneously. Doing so requires significantly more effort at the outset, but it generates far more options and creates a profoundly stronger position when negotiating the final purchase price. Sophisticated buyers make incredibly quick judgments and operational problems discovered during their review rarely stay hidden for long. If essential customer contracts are not perfectly organized, if historical financial reporting needs massive cleanup, or if employee stock option documents are scattered across old email threads and desk drawers, those are massive red flags. These avoidable errors will immediately turn highly qualified buyers away and must be permanently fixed long before the launch of any formal diligence process. This is precisely where establishing a rigid financial infrastructure like TechCXO's TRAPS framework becomes a distinct competitive advantage. Companies that already have a robust, fully scalable finance team, strictly adhering to strong transaction controls, reporting, and analysis, are not frantically rushing to rebuild lost records or explain glaring inconsistencies. What once seemed like extra administrative work becomes a distinct advantage when skeptical buyers start asking difficult questions. Beyond tending to the administrative paperwork, company leaders also need to sit down and ensure complete, unwavering alignment before they ever take their first meeting with potential buyers. Before officially inviting acquisition offers, the executive team must hash out several key strategic questions to ensure a unified front. What does a truly realistic valuation look like? And exactly how will the management team evaluate competing offers? What specific qualities matter most in an ideal acquirer, including cultural fit, eventual employee outcomes, founder legacy, and future equity participation? Which specific outside advisors, including investment bankers, specialized attorneys, and expert accountants, will help achieve the absolute best result? These pressing questions are not strictly about the money. A strategic buyer may offer more cash up front, but plan to systematically cut most of the existing team, while a financial buyer may pay slightly less but will be highly likely to keep the business operating exactly as it is. Thinking through these complex trade-offs proactively makes it vastly easier to act decisively when term sheets finally arrive. Furthermore, other hidden factors can completely derail a promising deal if they are not addressed up front during the exit planning phase. These include pending regulatory approvals that affect timing and structure, particularly in highly regulated sectors like healthcare or financial services. Employee considerations such as complex contracts, severance agreements, and equity plans triggered by a change in control must be ironed out. Additionally, looming tax issues such as lingering sales tax exposure or the complex treatment of net operating losses carry real, tangible weight. Dealing with them early lowers institutional risk and keeps the narrative tightly controlled. Once this exhaustive prep work is finally complete, the CFO's role transitions rapidly from strategic preparation to tactical execution. After the acquisition process officially begins, the CFO must take absolute charge of managing the aggressive timeline and controlling the highly sensitive information flowing to the potential buyer. While the CEO focuses their energy on passionately telling the company's story and keeping the core business growing, the CFO absorbs the intense, granular nuts and bolts of the transaction. This tactical work shares similarities with early stage fundraising, managing data rooms, fulfilling document requests, and fielding questions, but the raw intensity is on an entirely different level. M&A diligence is famously relentless. Requests arrive daily and quite often hourly, with buyers fully expecting same-day, flawless responses. A single missed deadline does not just slow things down, it immediately plants a seed of doubt, and doubt is the fastest way to kill a lucrative deal. In fact, the diligence phase is precisely where the majority of major deals are either won or permanently lost. When diligence is exceptionally well managed by a seasoned financial executive, buyer confidence builds rapidly. When it isn't, uncertainty inevitably creeps in and spreads. Executing a successful acquisition is rarely a solo endeavor. No CFO, no matter how talented, handles it entirely alone. The absolute right investment banker and legal counsel are essential partners in the trenches. While a seasoned management team can carry a significant portion of the weight, if leadership is newer to the complex realities of M&A, bringing in experienced outside advisors, such as a fractional CFO who has navigated these exact waters dozens of times, becomes critical. The rigorous groundwork completed beforehand, the specific advisory partners chosen, and the precise way diligence is managed ultimately shape the final outcome. When the preparation is flawless and the execution is tight, the deal inevitably closes on highly favorable terms, successfully transitioning the business and rewarding the founders for years of dedicated execution.